Welcome to the Radio Revenue Podcast.
It's great to be here.
I was walking through the grocery store the other day, wandering down the snack aisle. And let's be honest, that's the best aisle.
It really is. It's the fun aisle.
Exactly. All the colors, the comfort food. But I had this realization that I wasn't just looking at cookies and crackers. I was looking at a global empire. I'm talking about Mondelez International.
That's a very fair description. They really are the pantry of the world.
For sure. I mean, we're talking Oreo, Ritz, Cadbury, Milka, Toblerone, even Cliff Bar now. If you've had a snack in the last 24 hours, chances are pretty good you paid Mondelez for the privilege.
Right.
But here's the thing. Today, we're not just here to talk about how good a double-stuffed Oreo is. We're here to talk about the business behind the biscuit.
Right. We're doing a deep dive into their 2025 annual report, so that's the Form 10-K they filed with the SEC. It covers the fiscal year that ended December 31st, 2025.
And what a story it tells.
Oh, it really does. If you look past the glossy photos of chocolate bars, there's a very intense, almost dramatic story unfolding in those numbers.
Absolutely. And I want to set the stage for everyone because this isn't just a corporate report. It's a snapshot of the global economy. You've got inflation, you've got, and this is their word, soaring cocoa prices, and you've got consumers changing their habits.
It's all in there.
But there is one massive contradiction in this report that I really want us to unpack. It honestly made me do a double take when I first read it.
I think I know exactly where you're going with this.
It's the headline numbers.
Yeah.
So Mondelez made more money in sales. A lot more. $38.5 billion in revenue.
Yeah.
That's huge.
It's a staggering number.
But their profits, their actual take-home earnings, they dropped by nearly half.
It's a striking divergence. Usually when the top line goes up, you expect the bottom line to, at least follow along.
Striking. It's baffling. How do you sell $38.5 billion worth of snacks, which is an increase, by the way, and end up with 46.8% less profit than the year before?
Yeah.
That's the mystery we are solving today.
That really is the central question of their 2025. And to understand it, we have to peel back the layers. You have to look at the difference between, say, operational reality, the business of selling cookies, and the financial engineering happening in the background.
Okay, let's start at the top then. The revenue. $38.5 billion.
Correct. Net revenues hit $38.5 billion, which is an increase of 5.8% from 2024. On the surface, that sounds healthy.
Oh, for sure. Almost 6% growth for a company this big. Wall Street usually loves that. But then you scroll down to net earnings.
And that is where the floor just falls out. In 2024, they posted net earnings of $4.6 billion. In 2025, that number plummeted to roughly $2.45 billion.
So nearly half their profit just vanished. Where did it go? Do they lose a shipment of solid gold Oreos?
Not quite, though I'd love to read that insurance claim. The main culprits are actually these complex financial moves. The biggest one involves something called derivatives.
Ah, derivatives. Okay, let's unpack this slowly because that word always makes my eyes glaze over. It just sounds like Wall Street magic.
Think of it this way. Mondelez buys massive amounts of cocoa, wheat, oil, all that stuff. And the prices change constantly. If you're baking millions of cookies, you can't just cross your fingers and hope the price of flour is good tomorrow. You need certainty.
So they try to lock in prices ahead of time.
Exactly. They use hedging strategies, financial contracts that sort of lock in a future price. It's like buying insurance against the price of cocoa going through the roof.
Okay, that makes sense. It's just risk management.
It is. But the tricky part is that these contracts, these derivatives, have to be valued at their current market price at the end of the year. It's called mark-to-market.
So it's just a snapshot in time.
Precisely. In 2024, the market moved in their favor, and they actually recorded a gain of $544 million from these contracts. But in 2025, the volatility, especially with cocoa, went the other way.
Oh, no.
The value of those hedges swung negative, hard. They had to take a mark-to-market loss of $1.34 billion.
Whoa. So wait, let me get this straight. They went from a $500 million gain one year to a $1.3 billion loss the next. That's almost a $2 billion swing just on these paper contracts.
You got it. And that $2 billion swing hits the net earnings number directly. A lot of this is an on-paper loss for that moment in time, but it makes the final profit look terrible.
It's kind of like looking at your 401k during a market dip. You haven't actually sold the stock and lost the cash, but the balance just makes you feel sick.
That is a perfect analogy. The underlying asset is still there, but the valuation just got hammered.
Okay, so that's a huge piece of the puzzle. But I saw something else in there about a pension settlement That seemed like another big hit.
Yes, that's the second major factor. It's listed as the Mondelez Global LLC retirement plan settlement.
Sounds incredibly dry, but I'm guessing it was expensive.
Very. What they did essentially is they transferred their pension obligations to insurance companies. It's called a buyout.
How does that work?
Well, a pension fund is a huge liability on your books. You have to manage it, worry about market returns, people living longer. So Mondelez paid insurance companies a giant lump sum to take that burden off their hands forever.
So they're paying to get a massive headache off their books for good.
Exactly. It de-risks the company for the future, which investors like. But in the short term, specifically in 2025, it resulted in a one-time non-cash loss of $282 million.
Okay, so let's tally this up. We have over $1 billion in derivative losses, nearly $300 million in pension costs. That explains a huge chunk of that profit drop.
It really does. It's like they did a bunch of financial house cleaning and got unlucky with market timing all at once.
So if we strip away all that financial engineering, we have to ask, how is the actual business of selling cookies doing? Are people buying more Oreos or not?
And that is the billion-dollar question, or I guess the $38.5 billion question. Because when you dig into that revenue growth, there is a big catch there, too.
A very significant catch. I was looking at the section where they break down where the extra money came from, and it tells a really specific story.
It does, and it brings us right to the core tension of this entire report, pricing versus volume.
Right, so revenue went up 5.8%, but if you look at volume mix, which is basically the actual amount of snacks they sold, it went down by 3.7%.
Let me just repeat that. People bought fewer snacks, significantly fewer.
But they made more money.
Because pricing contributed an 8.0% increase to revenue.
So they sold fewer cookies, but they charged way more for the ones they did sell.
That's it. That is the inflation equation in action. They hiked prices to cover their own rising costs, and that pushed the revenue number up. But the consumer reaction, that volume drop, shows the other side of that coin.
It makes me think of that term economists love to use, elasticity.
Price elasticity, exactly. It's how much demand changes when the price changes. And for a long time, brands like Oreo and Ritz were thought pretty inelastic. You know, you'll pay an extra quarter for your favorite crackers.
But this report suggests the rubber band is stretching pretty thin.
It does. They explicitly mention elasticity impacts in Europe, Latin America, and AMEA, that's Asia, Middle East, and Africa. They're admitting that at these new prices, some people are walking away.
So the shopper blinked. They got to the shelf, saw the new price on the Oreos, and said, you know what, maybe not this week.
Or they switched to the store brand. That 3.7% volume drop is a huge warning sign that the consumer is feeling the pinch.
And it wasn't the same everywhere, was it? I saw the regional breakdown, and North America looked a little rough.
North America was a real struggle for them. In fact, revenue there actually decreased by 2.1%.
Wow. So raising prices didn't even save the top line there.
Nope. The report blames soft biscuits and baked snacks consumption. The volume decline was just too steep. Americans were just buying less, period.
That's fascinating. But Europe was a totally different story.
Completely different. Europe's revenue was up 12.9%.
That's massive, double-digit growth.
It sounds amazing, but you have to look at how they did it. Pricing in Europe was up 13.9%.
Wait, they raised prices almost 14% in Europe in 1 year.
They did. Very aggressive. And while volume did drop there too, the price hike was so huge that the total revenue number looked fantastic.
It's incredible how differently those markets reacted. Meanwhile, emerging markets seem to be the real bright spot.
Yes, up 8.5%. That's a mix of some pricing, but also just genuine market expansion. More people entering the middle class, buying branded snacks for the first time.
Okay, so we've established they're raising prices everywhere. My first reaction as a consumer is, hey, stop gouging me. But let's play devil's advocate. Why? Is something else going on?
It's definitely not just for fun. If you look at the commodity trends section of the 10K, they are facing a legitimate supply shock.
I saw the phrase soaring commodity prices.
And they use that specifically for cocoa beans.
Ah, the chuckpocalypse. I've been reading about this. The harvests in West Africa have been terrible, right?
Exactly. Climate issues, disease, aging trees. The global supply of cocoa is under massive threat. And if you own Cadbury and Milka, cocoa isn't just an ingredient, it's the lifeblood of your business.
It's not just cocoa, though, is it?
No. They also cited higher costs for dairy, packaging, edible oils, and nuts.
Even the nuts are getting more expensive.
Everything. Now, they did get some relief on sugar, grains, and energy, but the spike in cocoa was so severe, it really forced their hand on pricing.
And that ties right back to those derivative losses we talked about. They were trying to hedge against these crazy prices, and the volatility just chewed them up.
It's a really difficult environment. They're caught between soaring costs on one end and a consumer who's getting fed up on the other.
So what's the long-term plan? You can't just raise prices forever. At some point, no one buys the chocolate bar, but they're trying to grow another way.
They are. They're not just sitting still. One of the key moves they made was on the acquisition front.
Right, I saw a new name in there.
Yeah.
Evereth.
Yes, they bought a company called Evereth late in 2024, so 2025 was the first full year we saw its impact.
And who are they?
They're a leading maker of frozen cakes and pastries in China.
Frozen cakes. That feels like a bit of a pivot from a dry cookie on a shelf.
It is, and it's strategic. The report says Evereth added $316 million in new revenue in 2025.
Not bad. Nice little boost.
It is, and it specifically helps that AMEA region. It's a play to get into the cakes and pastries category, which is growing really fast. It opens up a whole new snacking occasion for them.
I like that. Their motto is snacking made right, so they're just expanding what a snack can be.
That's part of their bigger strategy, their 4 pillars for growth.
Let's run through those quickly.
Sure, pillar 1, accelerate consumer-centric growth. That's the Everest deal. Find what people want and go get it.
Okay, number 2.
Drive operational excellence. That's code for cost-cutting and making the supply chain more efficient.
Which they desperately need with these cocoa prices.
Absolutely. Pillar 3, build a winning growth culture. That's more internal stuff. And pillar 4 is scale sustainable snacking.
Okay, the sustainability pillar.
Yeah.
Every company has one. What does it mean for them?
Well, they talk about a goal of net zero greenhouse gas emissions by 2050, sustainable ingredients, that sort of thing. But given the cocoa crisis, this feels different.
You mean it's not just about an abstract idea of saving the planet?
It's about saving their business model. If you don't have sustainable cocoa farming in West Africa, you eventually don't have cocoa. If you don't have cocoa, you don't have Cadbury. Sustainability becomes a supply chain defense strategy.
That's a sobering thought.
Okay.
Well, let's pivot to the investors. If I own Mondelez stock in 2025, how did I do? Because looking at these numbers, I'm guessing not great.
It was a mixed bag, leaning toward disappointing.
Wow.
They have a graph in the report comparing their 5-year return to the S&P 500 and their peers. If you invested $100 in Mondelez 5 years ago, by the end of 2025, you had about $104.
Wait, $104?
Yeah.
After 5 years, with inflation, I basically lost money.
In real terms, yes. And compare that to the S&P 500, that same $100 would have turned into $196.
That is a harsh comparison. 104 versus 196.
It just shows you how tough the food industry has been. High costs, low volume growth. It's a defensive stock, but it didn't provide much defense.
But they're paying dividends, right? That's why people own these stocks.
They are, and that's the silver lining. They paid out almost $2.5 billion in dividends and even raised the quarterly payout.
So the stock price might be stuck, but the checks are still clearing.
That's the idea. And remember that pension buyout?
The one that cost them a few $100 million.
Yeah. While it hurt the 2025 numbers, a long-term investor looks at that and sees the company de-risking. They removed a huge, unpredictable liability. It's short-term pain for long-term stability.
Okay, that makes sense. So let's zoom out. If you had to summarize the Mondelez story of 2025 in just a few words, what would it be?
I would call it price over volume.
Explain that.
The whole story of 2025 was Mondelez protecting their top line, that $38.5 billion number, at all costs. They faced soaring inflation, and their main weapon was to aggressively raise prices.
And it worked on the revenue front.
It did, but they paid for it in volume. They sold fewer products. And when you combine that operational struggle with all the financial noise from derivatives and pensions, you get that ugly drop in profits.
It really feels like they are walking a tightrope.
That's exactly it. And that leads to the really big question for 2026 and beyond.
Because I look at that 3.7% drop in volume and I wonder, is this the new normal?
That's the provocative thought I want to leave everyone with. We talk about elasticity limits. In 2025, prices went up 8% and volume dropped almost 4%.
That ratio is getting dangerous.
Right. If they raise prices another 8% next year, does volume drop another 4%? Or does it drop 8% or 10%? At what point does the treat just become too expensive for the average family?
How much more room do they have to push prices before they permanently break the consumer's habit? Once someone stops buying Oreos for a few months, do they ever come back? Or do they realize the store brand is good enough?
That is the risk they are managing right now. They're betting on the power of their brands, but every brand has a breaking point. 2025 showed us we might be getting very close to that edge.
The battle for the shopping cart is getting fiercer every day. Well, that was a fascinating, if slightly concerning, look inside the pantry of the world.
It certainly was.
It's a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.